All right, let's just jump right into it. If you've ever even thought about investing, you've definitely heard of mutual funds. And almost immediately, that little voice in the back of your head starts whispering, wait, is my money actually safe here? It is a huge, important question, and today we're going to get you a crystal clear answer. We'll break down the real risks and, of course, the rewards. So, where does all this nervousness even come from? Well, it usually starts with one very specific and, let's be honest, pretty famous phrase.
Ah, there it is. You've heard it a million times, right? At the end of every TV ad, rattled off at lightning speed. It's the one phrase that makes most people just go, you know what? Nope, not for me, and completely tune out. It feels like a giant warning label on something really dangerous.
But that's the real question, isn't it? Is this just some legal mumbo-jumbo they have to say, or is it a genuine red flag telling you to run for the hills? Well, that's what we're going to unpack. We are going to figure out exactly what that phrase means for your financial safety. Okay, first things first. Before we go any further, we need to tackle the biggest misconception out there about mutual funds. This idea that investing in them is basically just a roll of the dice. It's easy to see why people get nervous. A lot of folks think of a mutual fund like it's a lottery ticket. You buy in, cross your fingers, and it's all or nothing, pure chance. But the reality, it couldn't be more different. A mutual fund isn't a bet, it's a managed portfolio. It's not about luck, it's about a strategy for spreading risk. It's not just you hoping for the best. You've got experts making decisions. And it is definitely not a random shot in the dark. It's a tool that's actually designed to help you reach your specific financial goals. So let's just get our definition straight so we're all on the same page. A mutual fund is simply a professionally managed basket that holds a whole variety of investments. We're talking stocks from different companies, bonds from different issuers, all sorts of things. The entire point is to not put all your eggs in one basket. Instead, you spread your investment, and by doing that, you spread your risk across a whole bunch of different assets.
Now, to truly understand if something is safe, we have to be honest and look at both sides of the coin. Every single investment has potential risks and potential rewards. So let's not shy away from it. Let's look at the risks head on.
And look, the risks are real, but they're specific and they're understandable. Tick market risk. That just means if the whole stock market has a bad year, yeah, your equity fund is probably going to feel it too. Then you've got interest rate risk, which mostly hits debt funds. Their value can wiggle around when interest rates change. Credit risk is the small chance that a company in your fund can't pay back its loans. And then, maybe the most important one of all, behavioral risk. And that one is all on us. It's that human temptation to panic and sell at the absolute worst possible time. But on the flip side of that risk, you get the rewards. And believe me, they are powerful. You get instant diversification, so your risk is spread out from day one. You have literal professionals managing your money for you. They're super accessible. You can often get started with a really small amount. And most importantly, you get the incredible power of compounding working for you over the long haul. And that, my friends, is how real wealth is built.
All right, we've busted the myths, we've got the definition, we've stared the risks in the face, and we've seen the rewards. So now we can finally answer that central question. Are mutual funds actually safe?
And the answer is, well, it really depends on your timeline. Are they safe in the short term? Honestly, no. The value can bounce up and down like a yo-yo from one day to the next. But are they safe in the long term? Yes, absolutely. If you choose the right funds for your goals and you have the patience to stick with them, all that short-term choppiness tends to smooth out, revealing that beautiful underlying growth. Okay, so knowing that the key is your timeline, how do you actually apply this to your own life? Well, it all comes down to a really simple idea, matching your personal goals to the right kind of fund. It's about using the right tool for the job.
This right here is where it all comes together. Your choice has to match your goal. So let's say you need the money pretty soon, in 1 to 3 years, maybe for a down payment. Well, a debt fund, with its lower volatility, probably makes the most sense. But if your goal is way out there, 5 years or more down the road, an equity fund, especially using a systematic investment plan, or SIP, offers way more potential for growth. And for anyone who wants a little of both, that's where hybrid funds come in, giving you a nice mix of stability and growth. So really, when you boil it all down, success just comes down to these 3 keys. Number 1, understand the risks we talked about. Don't pretend they don't exist. Number 2, set the right expectations. You're not going to get rich overnight. And number 3, and this might be the most important of all, stay invested with patience. You have to let your money do its work over time.
Which brings us right back to where we started. That disclaimer, subject to market risks, it's not meant to be a scary warning that sends you running for the hills.
A better way to think about it is as a polite, honest reminder about the fundamental nature of investing.
Because at the end of the day, it all comes down to this simple, powerful truth. There is no reward in life without taking some kind of risk. The goal isn't to avoid risk entirely. That's impossible. The goal is to understand it, manage it, and choose the risks that are actually worth taking to help you achieve your goals. And that is a choice only you can make.